people are coming in, I just want to thank everybody for being here. And a little bit of a housekeeping item. I'm going to try to monitor the questions and chat. So if you have a question throughout the presentation, webinar, just put it into the Q&A piece here, and then we'll either answer it if it makes sense during whoever's presenting, or likely answer the questions during the Q&A session at the end. I'll give everybody a couple more minutes to join here. All right, looks like people are making their way in. I'll just remind everyone once again, there's a Q&A box on the bottom of your screen, depending on how you have Zoom set up. You can click that and just pop a question in there at any time. We'll have a Q&A session at the end. And I will start the screen share here. And then I will kick it over. Oh, I'll introduce myself. I'm Alex Holtel. I'm the Chief Financial Officer here at the Foundation. I joined in February of last year, and I'm going to hand it over to Bob, who's our CEO.
Thanks, Alex. Good afternoon, everybody. I'm Bob Faulkner, President of the Community Foundation of Greater Memphis. For the past several years, we've hosted an annual briefing on the makeup and performance of our investment pools. And part of it is, from day one, the investment of our donors' funds has been a primary concern. Our mission is to protect and to grow those funds, and really with an eye toward, maintaining and increasing the charitable giving in our community. As you'll hear, we spent a lot of time during the year thinking through our investment strategies, consulting with our advisors, and kind of just reviewing what's going on in the world. Presentation this afternoon will be a little bit different from the past couple of years. For one thing, it's obviously virtual, but first we'll hear from Jay Healy. Jay's the founder and president of Century Wealth Management. He's a member of our board of governors and is also chair of our investment committee. So Jay will discuss how to choose an investment pool, and he'll showcase the 9 options that we have and cover what the returns have been in those pools. And he's also going to give us a little perspective on what the investment committee itself has been working on for the last year or two, and you'll see the results of their work in the numbers, which I'm proud to tell you. Then we'll have our investment consultants, Gerber Taylor, give you a little deeper perspective on our investment pools and on the markets themselves. And we do want to allow plenty of time for questions. I know some of you have them. Alex has flipped up the committee on the screen. I've always said that Memphis is a great place to put together an investment committee. We're blessed with individuals who have incredibly deep experience in the financial markets, and all of these folks represent that. The committee includes individuals with specific knowledge and experience in the full range of investment products, stocks, bonds, real estate, private equity, alternative investments, pretty much everything. They include both seasoned money managers and other kinds of financial professionals. So it's a really, really good group, and they have pretty deep discussions. But these are the ones that make those decisions. They do rely pretty heavily on Gerber Taylor's expertise, but they're free to, and as Gerber Taylor will tell you, often have deviated from that advice when they thought it was appropriate to do so. So again, the investment committee is chaired by Jay Healy, and I'm just going to turn it over to Jay at this point.
Thank you, Bob. Happy to be here. Happy to present this information to our donors. Long before I was served on the board or the investment committee, I was and still am a donor. And so I've been involved with the Community Foundation for roughly 20 years. and it's an honor to be here, an honor to serve the Community Foundation in general. So I'm sure that everybody is familiar with what the investment pools are and how they're structured and what they can be used for, but it's helpful to sometimes just back up and do a big picture perspective of how things are organized. And so we really have four general categories for these investment pools that represent different allocations and different risk profiles, risk and return profiles. At the top of this table, you see cash, and sorry, I switched. So cash is basically, a cash reserve fund. If you have money that is coming in and quickly going out, or maybe it's something that you want or need to be stable in the short term, then the cash pool is a good option to use. The fixed income pool is basically all bonds. It's relatively stable, but also relatively low returns. If you have let's say a medium term horizon for money that is going into your fund and also coming out, or you want a very stable investment profile, then the fixed income pool would be something to aim for. The balanced pool is a combination of fixed income or let's say bonds and stocks. And so if you have a donor advised fund that you think of as almost a retirement account where it's got a balance, but you're spending money on a regular basis, a balanced pool could be a good approach. If you want your money to grow, but also want some stability in how that allocation is structured, the balanced pool can be a good option as well. The equity pools, and there's multiple options there, are really designed for more aggressive growth. And with that comes the volatility of the stock markets. And so based on what you're trying to do as a donor, how your money is coming in, how you think it's going to go out, these different options are relevant to that, to those choices. And if you have any questions about how to structure it, there's plenty of resources within the Community Foundation that can answer your questions along the way. And if we look in more specifically, as you may know, over time, we have increased the number of pools and also added index pools as an option for all the donors. So if what you want from your investment pool at the Community Foundation is just to track the markets and to do so with very little volatility or very little tracking error from the markets themselves, and index pools are a great option. If instead what you want is less volatility than what the markets may provide, and the best practices or best decisions that the investment committee is making on behalf of donors, then using the active pools would be the direction to go. And within the so there, the cash equivalent pool there's only one choice there, but fixed income, there is an active pool and an index pool. On the balance side, there's an active pool and an index pool, and on the equity side, there is our equity active pool, which is basically the stock or growth portion of the balanced pool. And then there is the long leaf pool, which is a very specific portfolio made up only of long leaf funds, which is a very accomplished Memphis-based investment manager. On the index side, in the equity pools, there is US equity and international equity. These two together are part of the balanced pool, along with fixed income. So this gives you the option to create an allocation that is customized for your needs or desires based on a combination of the equity allocation and the fixed income allocation, all or either. So if you have any questions about the pools and how they're structured, feel free to ask and we'll answer them along the way. A quick summary of the returns for each of these pools. Starting with the cash equivalent pool, as you know, cash yields are very low right now. So over the last 1 year, that pool only returned 0.2%. Over a longer period of time, it has earned what cash earns in the bank, basically. And we compare that to T-bills as a metric or benchmark. The fixed income active pool, we compare that to Barclays Aggregate Bond Index, which is basically the US bond market. And one of the things you'll see here is that there is some differences between the returns between the active pool and the index, and that's by design. The active pool is structured so that it has less exposure to the risks of bond yields going up. So that's duration risk. And so by design, it's been structured as a lower duration allocation. And you can see in a quarter like the first quarter of 2021, when the bond market was down 3.4%, this pool was only down 1.5, and that brings the 1 year performance to actually a good number compared to the index. Over longer term periods, there's a little bit of gap between what this fund has done and what the bond market itself has done. But overall, the allocation and implementation is meeting expectations. On the index side, so this is an index fund that really aligns with the Barclays Aggregate Bond Index by design. And so you can see that the returns are very aligned with what the index is providing. Because these funds only got started, I think, in 2018, we don't have 3-year numbers, but we have the 1 year and first quarter numbers. On the balanced pool, you can see that we compare the balanced pool to an index, to a blended index, which is 60% of global stock market, which is referenced by the MSCI All Country World Index, and 40% of the US bond market. And the good news is that the active pool has done well over the last roughly a year. The first quarter, we were up 3.3% compared to 1.4 for the index, for the benchmark. Over the year, the 12 months, we were up 33.2 versus 31.1. And we'll talk about some changes that were made in the active pool, which I think we can credit to some of this success. But over a longer period of time, there has been a gap between performance of what we're aiming for and what we're getting. And I know that the folks from Gerber Taylor will go into a little more detail about that as well. On the balanced index pool, not surprisingly, the numbers match the index. So we're very closely tracking what we're trying to do, 1.7% in the first quarter versus 1.4 for the blended index. 31.7% for the 12-month return versus 31.1. And you'll see that the index or the benchmark for the index pool and the active pool are the same. And that's by design based on changes we made in the investment policy statement, which we'll go into in a little bit more detail in a second. On the equity side, and just as a reminder, the equity pool, the equity active pool is just the equity portion of the balanced pool, as I said before, and that performance has been good as well. So first quarter of 2021, up 5.1% versus the benchmark of 4.7. The 1 year numbers are 57% versus 55.3. When we start looking at 3, 5, and 10-year returns, there is a gap between the index and the pool itself, but that gap is closed some, partly because of the recent performance. And if we continue to see good performance going forward, those gaps will close over time as well. The long leaf pool, which again is just a concentrated portfolio of just a local Memphis-based manager, Southeastern Asset Management, had a very good performance for the first quarter and very good performance over the 1 year period. This concentrated portfolio has more volatility, and so you can see that when it's doing well, it tends to outperform significantly, but there are periods when that volatility has hurt the pool. This is very specifically designed for investors that just prefer this using this manager versus what we have otherwise provided. And then within the indexed portion of the equity pools, we have the U.S. equity index and we have the international index. And you can see that the performance there is really tracking very closely to what the appropriate indexes are. International is outperforming a little bit, but not every index fund matches its benchmark to the penny, but it is certainly designed to track that closely in the long term. So that kind of covers it from a performance perspective. I'll just give you a little bit of an update on the decisions that were made from the investment committee over the last year or two and how that's affected the pools. And I will back up by saying that it is a #1 priority or a high priority for the Community Foundation in general to enhance the experience of our donors and our nonprofit partners. That's part of the strategic plan for the Community Foundation. It's part of every board meeting. It's really the framework of how we make our decisions. And some of the decisions that have been made by the investment committee were definitely motivated by that. One of the things that we did was revise the investment policy statement. So that's what the investment committee uses to make decisions and make sure that we are abiding by the protocols that we've put in place in the past. And so the revised investment policy just reframes what the pools are supposed to do to make sure that we are on track with what we are trying to do and make it as efficient as possible. Another thing that we did over the course of the year was eliminate the hedge strategies or the hedge fund strategies that were in the balanced pool and the equity pools. Those are the active versions of the pools. And that, those are strategies that have been in place for a while. There was high expectations that they would have good returns, but reduce the volatility of the pools themselves. After considering whether that was working or not for quite a while, we decided to exit those strategies. And I think that has helped and hopefully will help going forward. We also adapted an approach to include or make it a priority to include minority and women-owned firms in our selection of investments. And so every fund that we consider, that is now a factor that that's in play. And many of the decisions that we've made recently have been to that, have helped us move the needle in the right direction there. And so approximately 57% of the balanced pool portfolio is managed by a firm that has ownership by minorities or women. And then, as referenced before, and that you're probably familiar with, we have created the passive investment options and expanded those options over time to include U.S. equity, international, fixed income individually, and the balanced pool, which is the combination of that. That really gives every donor the option to create a customized allocation, similar to what you might do in a 401k plan. And so that if anything that we have built doesn't match what your risk return profile is or what your cash flow needs are, you can use a combination of these funds together to get something customized to meet your exact needs. So that kind of covers what I wanted to talk about. We all work together as a team, and the Gerber Taylor folks, Matt Robbins and Bart Reed, are very critical to how the investment committee works. And so I will hand it off to Matt to cover everything in a little more detail.
Great. Thanks, Jay. Appreciate that. Bart Reed and I, my colleague at Gerber Taylor, are going to spend the next few minutes going into a little bit more detail around the construction of the portfolios today, talk about a few changes that have been made, focus on the returns, primarily on a risk-adjusted basis. All the returns you've seen are net of fees, but net of the manager fees, but there's no measurement of volatility or risk there. So we're going to spend a little bit of time on that, and then happy to answer any questions. So most of you know who Gerber Taylor is, so we're not going to spend a lot of time here. Obviously, we've been around for a long time, 32 years of being in business. We've got about $9 billion that we oversee today across a diversified client base, primarily endowments and foundations and pension endowments, foundations, and family groups. We do focus on multi-asset portfolios. We're employee owned, so nothing much has changed there. There are 44 employees, 18 equity partners with satellite offices in Charlottesville, Virginia, and Dallas, Texas. So that nothing really, the takeaway here is that nothing much has changed with Gerber Taylor. So it's been pretty consistent group. Just on the next page, again, just to re-emphasize our role, we serve at the pleasure of the investment committee. They have full discretion on the assets, and we're just providing advice on the items that are listed here. Everything from investment policies, spending a lot of time on asset allocation, focusing a lot on manager due diligence. We do an inordinate amount of manager due diligence, both on managers that are covered by the Community Foundation, other managers that are not employed by the Community Foundation. We've got a pretty big team of manager due diligence. And then we spend a lot of time on investment strategies, focusing on where we believe we are in the cycle for different investment strategies. We do provide a pretty comprehensive investment performance and evaluation report to the investment committee and staff. We do that every quarter, including all the total funds, strategies, and underlying managers, including returns-based analysis and qualitative analysis with the manager's portfolio. And then finally, we do spend some time with the committee on just recent trends and valuations related to the capital markets, and using that to inform us both on return and risk that we assume in the variety of asset classes that the Community Foundation has exposure to. Bart, if you'll flip over. Yeah, so on the balanced active pool, just to piggyback off of Jay's comments, you know, here we have a balanced mix of equities for growth, fixed income for lower volatility and capital preservation, and mixing those two to try to come up with a balanced mix of equities and fixed income that can deliver, good absolute returns for the donors. If you go to the next page, just how the balance pool is constructed today. One thing that we mentioned earlier was no hedge strategy. So that is a material difference today than what this pie chart looked like, say, 2 years ago. Those proceeds were moved into the equity side of the portfolio and into the fixed income side of the portfolio. We got a lot of that rebalancing done at the end of the first quarter. So the timing of that was very accretive, given how much risk assets have recovered and blown through to new all-time highs, despite being in the midst of a global pandemic for COVID-19. Just a couple of takeaways here. If you look at the kind of the left-hand side of the pie, that's all of our kind of our offense, our equity, and you can see it's really diversified. About 27.5% of the portfolio is allocated to the U.S. equity market. Our foreign exposure is about 23%, divided between the developed world, international equities, and the emerging world, emerging markets. And then we do have some allocation to private equity. That's been an area that the committee has worked hard on and has begun to try to get implemented through some really solid management relationships there. We believe private equity is a great allocation for any long-term pool of capital. And then we have real assets of about 7.5%, which has been expanded and includes primarily real estate related investments today. 35% in fixed income. So thinking about kind of the mix of offense and defense is about 65% offense, 35% defense. I'm not going to talk a lot about the performance. Jay did a pretty good job. We have been very pleased with kind of the near-term results. I would say just a couple of things here. In the near term, we've seen the markets really broaden out. You've seen small cap equities be more competitive with the large cap market. You've seen international emerging markets take a greater lion's share of the total equity gain globally. So they've been much more competitive. And that broadening out of market participation is helping, any diversified investment program, particularly like the one the Community Foundation implements here in the balance pool. The more intermediate term numbers here, certainly we'd love to be above the 60-40 mix of stocks and bonds. I would say a couple of things that have been headwinds. Our diversified allocation certainly has been a headwind. When you look at the last 10 years, just to kind of give you an idea, I think the U.S. equity market has compounded at something like 14% per year, most of that coming from one particular area of the U.S. equity market, large cap and technology. Certainly we're more diversified around large cap and technology. The international markets are up something like 6% over that last 10 years. So any allocation to the foreign markets has been certainly a headwind. And then we've been more conservative on the bond side. And bonds in the last 10 years have had all the tailwind at its back as interest rates have gone from something like 5% and troughed at about 0.5% at its lows last year. Certainly that's kind of come back. So allocation in the near term has been very accretive because we're not taking the same amount of risk and we got a slightly lower allocation of bonds. And then the broadening out of the equity markets has certainly helped us in the near term. It has been a headwind in the last 10 years. Long term, since inception, this goes back to 1995, the portfolio is compounded at a little over 8%, which is over 0.5% per year greater than the 60-40 mix. And that includes the long-term capital crisis in the late 90s, the NASDAQ bubble popping in 2000, the great financial crisis, and more recently, the COVID pandemic. So there's a lot of cycles that this portfolio has gone through, and it's been over the long term pretty accretive. Just to kind of give you an idea of what the 70 basis points means to you as a long-term investors, if you'll flip the page, this kind of shows the growth of $100. So a $100 investment in March of 1995 in the balance pool has grown net of fees to $764. And then you can see the 60-40 mix, $100 just invested in the passive 60-40 has grown to $645. So there's about 100 percentage point return differential on a cumulative basis, which accrues into the dollars above. So I think the one thing that you'll see kind of in that green shaded area at the bottom, the cumulative excess return, you can see there's volatility to that. It's very cyclical. And so, the way these portfolios are designed are, we know we're probably through diversification not going to capture every last, basis point of the upside, with the hopes that we protect capital in down markets. And so you'll see, and you can see that, I think, on the next page, just kind of how the portfolio has done, both in good and bad markets and kind of over the long term. But here, this is just your standard risk return chart. The black diamond centered up at the top is just the 60-40. What has our return and our risk level been relative to a 60-40 mix of stocks and bonds? And you can see you've had better returns with lower risk than the 60-40 over a period of time where we've had lower allocations to fixed income. So the diversification and active management have helped constrain the risk of the portfolio. And then notably, if you look at the upside and downside capture, that's just giving you the percentage of the 60, how much return the balance pool is capturing when the 60-40 mix is up, and how much of the return are you capturing it when it's down. And so you can see we don't capture 100% of the upside, but what the portfolios do is tend to do better on the downside. And that's where the portfolio generally has made a lot of its relative return is protecting capital, which is always front of mind to donors when markets get really shaky, just particularly like they did in the first quarter of last year. If you look at the next chart, here it's a little bit busy, but look at the numbers on the bottom left. You can see the balance pool is annualized, and these are numbers as of December 2020. We're comparing the numbers here at that time period because this is a universe of endowments and foundations, and that universe cut has not been completed for March 31st yet. So the rankings probably are going to get a little bit better here. So the 8% rate of return is in the top half of a broad peer group of endowments and foundations. There's something like 1,200 different endowments and foundations that make up this universe. So top half performance. And then notably on the right-hand side, this is just measuring the volatility of that 8% and kind of how that ranks relative to other endowments and foundations, because every endowment and foundation is pretty unique on their goals and objectives and how they're structured. So what's our risk level been relative to the broad set? It's actually, we've had lower risk than about almost 80% of our competitive set. So, so again, top half performance with lower risk than almost 80% of the peer group. So, if you go to the next page, just again, real quickly on the equity pool, it is diversified. It does have exposure up and down the capitalization range around the world. It does include growth and value strategy, so it's very diversified. If you look on the next slide that we'll show you here, this allocation is a lift out of the exact allocation that we have in the equity component of the balance pool. So when the committee makes decisions, increase, US versus international or emerging markets, or move up and down between large cap and small cap, we replicate that decision across the equity pool and vice versa in the equity component of the balance pool. So here you can see about 55% of the portfolio is domestically invested. The committee did last year up its exposure to the small mid cap part of the equity market, which has been very accretive, and did move some more money in the U.S. equity portfolio. So those are a couple of shifts that have been made from an allocation perspective. And you can see about 35% or 45% of the portfolio is invested overseas. And that mix between US and international emerging markets closely replicates kind of the global market cap between US equities and foreign equities. Bart, if we can just, again, I would say a couple, just again, I think the same themes here are broadening markets, better small cap participation, value strategies doing more competitive with growth, and the foreign markets doing better have all helped a diversified equity program. And you can see the the 1-year results reflect that. A similar dynamic to the comments earlier about the last 5 and 10 years, just the material underperformance of the foreign markets relative to the U.S. market, and then the U.S. market being fairly concentrated with most of its return coming from consumer and technology companies. That's been a headwind relative for the diversified equity program like this. But the long-term results have been very good. It's compounded at 10% net of fees. That's in excess of the global equity market since inception. And that inception number, if you flip over to the next page, goes back to 1990. So that's a 32-year track record that's been developed by the Community Foundation. Here, the same analysis. How has $100 invested in the balance or in the equity pool relative to the All Country World Index? And you can see it's about 1,000% better on a cumulative basis. So that 2 percentage point spread, is really magnified as your time horizon increases. So, and it really makes a big difference in donor dollars over the long term. So again, I'm gonna just be brief on this. Again, the volatility level of the equity pool has been less than that of just passively oriented in the global equity markets. So better returns, a little bit lower risk, and again, in classic diversified fashion, we capture about 80% of the upside, but we've historically, the Community Foundation donors have only experienced about 62% of the downside, which I think is even more important on an equity portfolio because of the greater volatility of owning equities outright. So it's really important to protect capital when things go awry in the risk markets. Just to be quickly, just to summarize this, when we look at the results of the Community Foundation versus other actively managed equity strategies, it ranks really well relative to its competitive set. Over the long term, the 9.9% as of December 2020 ranks in nearly the top third of global equity funds, and has done that with risk levels that are essentially lower than every other competitive set in the program. I think if we would have known kind of what the last 10 years had laid in store, you've been paid to take more risk, we probably would have been even riskier than what we're showing here from a risk perspective. But our managers were primarily, it's actively managed, so they help kind of control the risk through their company selections and management of their portfolios. We lean on that a lot to kind of control risk as well. And then finally, let's go to the fixed income pool. Here, nothing much has changed. I would just say, as we're showing you here on the third bullet point, this is a diversified mix of fixed income securities. The lion's share of it, in fact, nearly all of it, is investment grade fixed income. We do not have a specific target to high yield or junk bonds in this portfolio, never have. We tend to want to take risk in the equity markets where we think we get paid, and certainly today would not recommend large allocations to high yield bonds or junk bonds with kind of where we are in terms of spread, the relatively tight spreads and low yields prevalent in the fixed income market. The way it's allocated, if we can go to the next page, is it is diversified across 3 different managers with distinct allocations. You'll see that about 50% of the fixed income allocation is in a short duration mandate. The committee has been very intentional about having a lower duration profile with eyes wide open that, in a low interest rate environment, there is higher sensitivity to changes in interest rates when yields are at very low rates like they are today. So, and that's helped this pool tremendously this year, and in the last 12 months be able to deliver those excess rates of return. You can see just today, if you're investing in the bond index fund, you only get about 1.3% of nominal yield. That doesn't even factor in, inflation. And then their duration around that is about 6.5 years. So, the way the portfolio is structured today with its lower duration profile, you get a pretty decent yield. Not a great absolute yield, but when you think about it compared to the 1.3, you're getting the lion's share of the market's yield, but you're taking about half the duration risk to get it. So certainly there is a trade-off here, and this program today is more designed to, really protect if we get into a rising interest rate environment. And it's part of it is passively managed through the Vanguard total bond market index there at 20%. The 30% here is actively managed with a group called TCW MetWest. Again, just won't belabor performance, just to make on the next page, just a comment that, the volatility level here has been less than the bond market over time. We're showing you this going back to 2008. The committee in 2007, kind of in the financial crisis, kind of emerging from the financial crisis, we did a lot of work with the committee to reorient the fixed income pool, to try to take a lot of credit and concentrated manager risk out of it. And I'm pleased to report that, 12 years later, 13 years later, the return has been commensurate with the bond index, and the volatility has really been constrained in the program. So, and then lastly, just one more comment on performance. 10 years we haven't been able to keep up because interest rates have gone down, and having a lower duration portfolio, you're not going to keep up. So, but on the other flip side of that, you can see in the near term, in the last 12 months, that protection of capital that Jay had talked about and illustrated in our last quarter when the bond market was off 3.5%. This portfolio is off 1.5%. The last 1 year, that protection of capital in the quarter really accrues to you from a return perspective, and that's really illustrated in the 1 year column. And then Bart, I would not much to just really comment here. I mean, I think relative to the universe, the way we are implementing fixed income looks a lot different than most other international managers, particularly on the active side, because we don't have any high yield or a lot of credit risk in the portfolio. Our returns are just not going to stack up because of the way we've been intentional about having a lower risk fixed income portfolio. And that really is illustrated on the right-hand side here. You can see the volatility level relative to kind of the average, manager, it's much lower. So, so that is pretty much within expectations based on how we're allocated in the portfolio today. So those are kind of the profiles of the actively managed pools. I'm going to turn it over to Bart to go briefly over the index pools.
Thank you, Matt. Given the competitive nature and low fees associated with index investing, the investment committee has been proactive in providing options for donors to access, index options for their investments. And among those are a balance pool that allocates U.S. equity, international equity, and fixed income, a direct U.S. equity pool, an international equity pool, and a fixed income pool, so that donors can choose, their mix of these asset classes. And the way we've implemented these investments is through Vanguard, who's has been one of the global leaders in index investing. They have some of the lowest fees, available, and they also have some of the best tracking error compared to the indexes that they have that they're trying to mimic. If you look at the performance here on the next page, tracking error has been pretty close. Performance has been close with the indexes that are being replicated. Again, the balanced index pool compares pretty favorably to the 60-40 mix of stocks and bonds. Long term, the U.S. equity pool is right in line with that of the Russell 3000 index. The international equity pool is actually slightly outperformed the MSCI ACWI ex-US index, and then the fixed income pool is right in line with the Barclays aggregate. And then here is the allocation. So for the balanced index pool, so the committee wanted to have a broad level of diversification within this balanced pool index, and so having exposure to both U.S. equity at 32%, international equity at 28%, and then fixed income at 40%. So it is a broad. You can easily access a broad level of diversification through the balanced index fund. And then we wanted to provide an overview of the managers that the Community Foundation is utilizing across the investment pools. And you may have seen this page in past presentations, but we wanted to add one more aspect to that. The foundation has been proactive in looking at allocations to minority and women-owned firms, and this outlines those allocations highlighted in yellow. So from it's approximately half of the managers across the pools are minority and women-owned firms. And if you look at a percent of the assets within the balance pool, about 57% of the total market value is invested with firms who have minority or women ownership. Another takeaway here is the level of diversification that you're getting across the pools. There's 10 U.S. equity managers that we have options for, 5 of those being minority or women-owned. 7 international equity managers, almost all of which are minority or women-owned. 2 private equity managers currently, and that portfolio continues to get to be built out. In the real asset space, you have 3 managers within the balance pool. Again, and that space continues to get built out over time as well. Another aspect we wanted to look at here and show you is the number of local managers that the Community Foundation utilizes, and there's 7 of those total. Delta Asset Management, or 7 strategies total. Delta Asset Management, the Longleaf Partners Fund, as well as a small cap in the International Fund, New South Capital Management, and then Highland Capital Management as well.
I think we've always said that we would prefer to have local managers in areas, where they have a particular expertise, but certainly we'll go outside of the local market to find, manager talent and strategies where we might not be able to find it here locally. But I think it's a pretty good mix of local, tapping into the local talent, and then expanding outside of the local area to find, managers that are bringing some expertise into a particular strategy. So, that was the kind of the review that we had planned, and happy to answer any questions that may be coming up.
Yeah, just remind everyone that you can enter questions in the Q&A, and we have a couple here queued up. First question comes to us from Jim. And the question is, why not expand the passive investment options? Seems like it would be relatively easy to add and give donors a greater ability to manage their donor advised fund in a way that they manage their own money.
Yeah, and I'll take that. And we agree. And that's part of the reason why we've added more options in the last 2 years. The challenge is we're just trying to be responsive to what our donors and our nonprofit partners that have funds with us, what they're looking for. We've created these 4 indexed options over the last 2 years. 2 of them, the balanced index pool is actually pretty good size. It's over $10 million. But 2 of them are under $250,000. So, you know, it's easier to be more responsive to our donors and to our partners when there's real demand. It does take some time and effort and cost in managing independent pools, and also the fiduciary responsibility for the committee to follow up on those is bigger. So it's just if there were demand for a lot of different more options, and there'd be significant assets behind them, we'd certainly do that. But I don't really am not quite as interested in managing a lot of little tiny pools, $100,000 each. So you know, bring your friends, I guess, is the moral of that story.
Thanks, Bob. We do have another question here. So it seems like the risks in holding a fixed income bond allocation are higher than I've seen in 35 years of investment management, given the steepening yield of the yield curve, rapidly growing government deficits, number of highly leveraged companies, and undeniable inflation we're seeing. Can you speak to how you view these risks, and at what point would you adjust the balance pool allocation, possibly increasing cash and reducing fixed income?
I will. I'll jump in here on that. I mean, I think all of those certainly are where we are today in the markets. There's a real risk that fixed income returns could be provide no real rate of return and very poor returns looking forward. Certainly at 1.3%. You know, the issue is when you go to cash, you know, cash today is zero. So, you know, you don't get anything in cash. And there could potentially be an opportunity cost there if you have if you have a longer time horizon. I think certainly the markets have been supported by the incredible amount of intervention by central banks around the world. And, you know, certainly that could lead to, you know, certainly unintended consequences for sure. So I think the way we think about it, you know, as a firm and what we've talked to the committee about is we think that's why you want to have managers that are actively managed, that know their companies really well, that can kind of sift through the volatility of the markets and help manage the risk, you know, at the underlying portfolio level. So we want to be diversified because we think that is one tool to help control volatility and risk in a portfolio, and then having really good managers on the bond and equity side to know the companies that they invest in to help manage, you know, the underlying portfolio risk as well. So I think the committee is very intentional about taking kind of a dual approach to it. And that's well, kind of how we've implemented it.
Yeah, that's well said, Matt. And I will also add that historically, since the Great Recession, when bond yields were similarly low to where they are today, we had reduced the allocation to fixed income within the balanced pool to, I think, 25%, which was the limit that we could go to under the investment policy statement. And then even within our fixed income allocation, we reduced duration over time as well. And so those are the type of options that we have to manage this risk. But getting out of fixed income totally and going to cash is just not what the investment policy allows us to do.
Thanks, Matt and Jay. This question was sent in, we kind of talked about this in the prior webinar too, but just basically on cryptocurrency. Do we have exposure to cryptocurrency? And then kind of follow-up question, is there a recommended mix for organizations to have exposure to crypto?
I mean, at this point, I understand the speculation in cryptocurrency. It's not a reasonable, in our view, I think it's not a reasonable activity for an institutional investment portfolio. It's the kind of thing that an individual is welcome to do on their own, but I don't expect us to offer cryptocurrency options anytime soon. And Matt can comment on, I don't think that Matt or Bart can, I don't think there is any exposure in any of our existing pools to cryptocurrency investments.
I can't think of one manager that would have any exposure to crypto other than they might have a position where a company has some, I mean, maybe in the private equity side, we might have a small exposure, but nothing material to have, and don't expect to have any exposure really to the asset class. I think we struggle with it because I think our DNA is we kind of want to store value and want to be able to price something. And to me, cryptocurrency is just what's the next person willing to pay for it and what's the fallback value. I mean, at least with the dollar, you kind of know, you can get your physical hands on it. With cryptocurrency, it's a different animal. So we have not recommended to our client base to invest in cryptocurrencies. If managers want to do that, then that's, we think that they may be more informed than we are, but we expect we have zero exposure to crypto and would not have a recommended allocation for it.
Yeah, Bart, you had brought up a good point earlier, which was, we don't really have exposure to currencies necessarily, to foreign currencies or other pieces too. So, but that being said, if you have a significant amount of cryptocurrency that you would like to gift, we would have the conversation. If there are any other questions, feel free to submit them through the chat or the Q&A. Not seeing any questions, so Bob.
Yeah, Alex, there was that one question that was submitted before on inflation.
Oh, sorry. I think we may somewhat come. So comment on your inflation outlook and its impact on real returns. How would you hedge against that? I think we kind of talked about that, but Jay spoke to some.
I will take that. Historically, equities have been, companies have been able to take pricing power and offset the impact of inflation. We think higher quality balance sheets and companies are better able to mitigate, or navigate through higher inflationary environments, which we have not had in 40 plus years. Certainly haven't seen it necessarily in my career, which dates back to the mid 90s. Certainly haven't had a deflationary environment like we've been through in the last 10 years either. But I think, from an asset class perspective, we think of equities can generally be a pretty good hedge because of the pricing power of companies to offset that. Bonds are kind of stuck unless you're willing to do some floating rate issues there. We kind of think of the real rates of return on fixed income, they're basically negative today on a real return basis. Equities provide you with some real return opportunity. So I think the way we would hedge that is basically being more allocated towards equities, which we are in the balance pool, and have a little bit lower, allocation to fixed income, which we're today at 35%. So, if you want to get more aggressive on an inflation hedge, then certainly you'd want to have more equities. The other thing that we have in the portfolio today is the real asset allocation. So real assets tend to be a good inflation hedge. So as inflation runs through on buildings, perhaps on leases, which generally escalate in real estate over time, those tend to be be ways to maybe hedge a little bit higher inflation. So I think we're a long way away from the 80s. Might not get there. The makeup of the market has changed a lot. It's certainly more levered to technology, which has been a big deflationary mechanism for the markets. But certainly because of the amount of capital that's been pushed into the markets and all the liquidity sloshing around, that you could certainly see higher inflation. I think that's another reason why interest rates have gone from 0.5% to 1.5%, essentially in the last 12 months. So that would be our comment on that.
Thanks, Matt. We do have another question. How have the private equity funds done, and what's our intent to use them going forward?
So the private equity we're pretty young in private equity. It's been an allocation that is pretty young. We've got really 3 funds today. 2 years ago, we only had 1 fund investing in private equity. I think the return in private equity has been something like 12% on an internal rate of return basis. So it's done really well. We are building that. We've worked with the committee in earnest in the last 12 months to identify and build out our private equity allocation. And we think of it just as another way to access the equity markets. Here we take more illiquidity risk because these managers are investing in private businesses over a 3 to 5 year period, but we think we're going to get paid in return by assuming that illiquidity risk. The other thing is we think managers that you have exposure to in this space have a real skill. And Headlands Capital is a group out of San Francisco, California, that basically approaches the private equity markets from a secondary buyer perspective. So they're out trying to find pools of capital where they can actually underwrite the net asset value of the businesses that they own in these private equity pools and buy them at a discount, versus Accolade Partners, which is a new allocation in the balance pool, is a group out of Baltimore, Maryland, and they're a venture capital focused and growth equity focused portfolio, essentially investing in managers in the kind of the middle market and small cap area of the venture capital space. So, we like private equity. We think it's differentiated versus the public equity market exposure that you have there. So it gives us some differentiation. And we think the returns, are going to be accretive relative to what's afforded to us in the public markets. So I think one thing for the donors to remember is that the committee has been very cautious on the illiquidity because the donors are liquid and can request dollars. So we've been pretty cautious about taking on more illiquidity risk. And so we've been pretty conservative and patient on, allocating to private equity and doing it when we think we've found a really good fit for the community foundation.
Yeah, and let me just reinforce that. That was the point I was going to make, that we do like private equity. And if we were an endowed foundation that knew we were going to have the corpus around forever, we would certainly, or almost certainly, have a more significant allocation to private equity. But most of our donors could grant out all their funds tomorrow, and our nonprofit partners could take their funds back tomorrow. They don't. And that's, as a practical matter, that's not going to happen. And we've been through a couple of bad markets where that wasn't happening, but that is a concern for the committee that we know that we do have more extreme liquidity issues than a normal endowed foundation. And we're just trying to be careful with that.
Matt and I checked to confirm that IRR for the private equity pool or private equities effort has been 12.4%. So starting in 2016.
All right. If anyone has any other questions, you can submit them through the Q&A.
And not seeing any, I think that we've had an opportunity for people to type something in, and I think we'll probably just end it there. So again, thank you all for joining us. It's really important for us to hear from you and hear what you need and what you want in terms of on the investment side. Frankly, all of the indexed options that we offer have come from meetings like this where we got feedback from you all. So if you have other thoughts or how any good thoughts on how our investments could be more diverse or attractive to you, let us know. I've been happy to see that as hard as the investment committee works, it's good to see over the last year to year and a half their hard work and their changes to the balanced active pool, which is by far our largest pool, come home to roost. All of our long-term numbers have always been good, but we have struggled really since 2008, 2009 to keep up with the market, partly because we were being pretty conservative, and as the market continued to sky, we were creating some of our own headwinds. But because of the affirmative actions that we've taken over the last really 18 months, we've turned that around. So our trailing year numbers are better, and quarter to quarter they're looking better. So we're happy to see that. I also wanted to remind you that that when you make these investment decisions, they're not static. You have the option to move investment choices around as your tastes change, and you're free to mix and match however you want. You're free to use our funds in whatever combination you want. Just let us know. Well, I think that just about does it for us. So thanks again, and we're privileged to be able to work with you and help you make Memphis a better place. That's what we're all here for. So thanks to everybody.